Welcome to the Week in Italian Startup, where we discuss the latest highlights happening in the Italian tech and investment ecosystem. So let's start talking about a few deals from last week. Actually, the last week was a little bit on the slow side, but the rounds are still holding. A few vertical have been touched. A variety of deals, I would say, and then we can examine in particular. So starting from BookRepublic, digital ebook library, raising 1.5 million from Mondadori, with a further commitment for an additional 1.5 investment in 2025. So the idea is that they're gonna basically jointly work on an app, which apparently is called Narae, which is focusing on web novels. So is this the disruption of fictional reading? I mean, we're all fans of books, but they're probably gonna stay, but that's probably the new wave of reading fiction. People use it on their phone all the time. Is the easiest, most accessible, and most distributable asset and tool. So why not? I mean, very, very interesting play. What is your hot take on this one, Nick?
Well, I don't know whether I have hot takes. I mean, I'm amused by the concept of web novels. I was not absolutely aware of it, but I haven't had much time to read lately, as you know. I would say that this is an interesting deal in terms of structure, in terms of actors involved. Mondadori on the side, and BookRepublic on the other. That I wouldn't call actually startup, since the company has been around since I believe 2009, 2010. So the company is 10 years, at least 10 years. So it's more a mature side in a sense, but apparently positioned to be an actor in this new market about web novels. So a trend that I was not aware of, and that will be interesting to further dive into. And the structure of the deal is, not particularly unusual, but still, 3 million into tranches, one now, one going forward. It's not clear to me if it's equity purchase in BookRepublic or an investment in a full-fledged joint venture. That's not clear. I don't know whether you have a clear idea.
Yeah, no, good point. I mean, from the information we can gather, and here is purely speculation, is that it looks very much like sort of a mixture between like a startup / M&A sort of deal, because a few things to notice are that basically the company has been working with Mondadori for a few years actually. So it's not something new. It's not that they've been scouting BookRepublic and then they decided to invest sort of VC-like style. It looks like there was some previous work of actually knowing the company and seeing it growing, and then now with this like staged sort of financing, it really feels like a sort of a quasi M&A sort of thing. We don't know if, of course, they're going to acquire the majority, which I might imagine they probably will. But yeah, that's definitely like a good way to structure. And obviously to the founders out there, corporation can actually be good for growth and exit opportunities. And that might be like another of those cases.
Yeah, just for context, what is BookRepublic? Is basically an online library focused on ebooks. So it's sort of tangential to the business model. I mean, downstream to the business model of Mondadori in some sense. So what you're saying makes full sense. Let's work on this joint venture going after an interesting new market, but overall there is a potential for acquiring the entire company. We'll see. Maybe that's a potential take.
Yeah, I mean, maybe like some highlights on the web novels. That's interesting because I think when I think of this, of course, two things come to mind. The first one is sort of the Netflix effect, where actually you hook people by having highly engaging form of literature that can actually be like, I think in the 19th century, they were mentioning how in the 19th century, like initial, like newspaper, they would publish like novels in different issues. And this is kind of the version of the 2.0 version of that. And what is interesting is that back in the days, a lot of like famous writers started writing for magazine and news and basically like journals in general that were like distributed by paper. Think about Mark Twain or other big writers. Maybe the next generation of writer would kind of use this tool to actually, build some audience and then, come out with books. And that's the new way of being an author, probably. That's something that will shift.
I was thinking about starting out with a newsletter and then becoming a book writer. So that's probably...
Interesting. Yeah. Interesting.
That's another potential.
No, definitely. Blog.
I don't have any books in the making, anyhow.
Not yet.
No, not yet. I don't know. Probably never. But
also. So yeah, that's definitely an interesting deal. And the second thing I was thinking is that the huge success that actually manga reading and like base have been with this sort of model. So visual web novels, it's massive in a lot of countries, especially in Asia. And I wonder whether this can be actually replicated with actually written fiction, because manga is easily consumable. You flip through your phone. It's like a little cartoon, so it's easily to digest. A web novel, I don't know, is it gonna be the same in terms of ease of consumption, or it's gonna take like a little more? We'll see.
Good point.
So moving on, let's talk about NExT, modular electric vehicle startup raising 1.25 million from Cysero. So Cysero has been like a very active investor in the past couple of years. Let's talk about NExT first. So NExT is basically developing a system of modular cars that essentially are gonna try to minimize traffic and optimize for usability in terms of in-city traffic. So it's very interesting. You see like different modules. They are standalone modules, or actually they can be joined together in a sort of a bus-like configuration. And that's how exactly Swarm sort of the way of thinking can actually be applied to traffic management. So the idea is, of course, building optimizing for sustainability, optimizing for traffic, and livability in cities. Very interesting play. Talking about the investor, Cysero. So Cysero, have been active in robotics and cybersecurity. We've been talking about Cysero for a few deals. Everything is managed by AVM Gestioni. And AVM has been very, very active also, like building different kind of funds. So I believe that they have like 4 funds which are active right now. So Fondo Talent, Cysero, of course, Italian Fine Foods, and Rialto Digital. So it's very much not a purely digital investor. They actually work with also like small and medium enterprise in general. And not necessarily like in the most cutting edge technology. So it's a nice mix actually. It's like a little food, like Rialto, for example, is doing a lot of AI. The team is very well prepared on AI, and of course like other play, like more sort of long shots, like this one in NExT probably.
Yeah, I have to add that Cysero is. Also involves the Chilometro Rosso. Basically, how do we call it? Program.
It's an innovation hub.
Innovation hub.
Yeah.
And it's one of the key partners and investors in the fund, and provides a lot of insights and competence around robotics in particular. And mobility. So it's it's an interesting proposition.
Interesting play. Also, Chilometro Rosso can really, have a great look at what's happening next in the automotive technology. So, for example, Brembo is part of Chilometro Rosso, the car brake manufacturer. So, pretty relevant to underline. And it's probably interesting how exactly the interaction work, where probably people in Chilometro Rosso will vet the deal from a technical standpoint to actually assess the feasibility and how exactly probably there is some valuable technology. So it's a good sign for them. And it's a great opportunity to grow for sure. All right, talking about Amalia Care, healthcare startup raising 1 million from Personae. So Personae is a CDP-powered accelerator, which is also basically participated by All Impact, Social Fair, and then a few other business angels. So Italy has an aging population, the cross between digital and the services to the elder. It's an important vertical that has been actually moving faster, I feel, in the past 2 years. We didn't see much of that before. It's something that has been growing a little bit quicker, also with investment operators actually focusing on silver tech. So that's a strong signal in terms of these kind of deals. And it makes sense. As we were talking, it's a very practical angle when it comes to actually providing services, very powerful, especially Amalia in particular. So essentially, Amalia Care is a marketplace pretty much, matching the demand for home professional that take care of the elderly with the demand from families that actually require those services. So it's a big problem. Very low, like a very, very not too much digitized, I would say. And they have a good shot of actually being the primary marketplace in the country, actually, I would say.
Yeah, I was taking a look at the numbers. If you think at the Italian population, the number of people that are currently receiving a public pension was 16 million at the end of December 2022, with many of them being aged over 80 years old. Of course, not all of them need some assistance, for sure, but the number is huge. If you think we are just like less than 60 million, probably 59, 58 million now. So it's a huge number and destined to grow.
Yeah, I mean, so to be a little bit cynical, it would be interesting to see how much is growing compared to how much is decaying. So that's probably another interesting metric to see, but probably there is it's skewed on the positive, on the growing side. Probably that's my
No,
tweet.
no.
No,
I was reading a statistic from I think last year. The net growth in population last year, I believe, but the year before last one was net negative. So even accounting for immigration and new
Okay.
births,
Okay. Wow.
if you account for immigration and deaths, the net population growth was negative.
Interesting.
So we'll be around for just if this trend is true. I kind of remember we'll be around for just a couple of centuries and then no more
Wow.
Italians.
Unbelievable.
If
That's
this,
it.
so the trend
Done.
is fast. This is true.
It's very fast. Yeah. Very interesting. Very interesting.
A bit sad in a way, but
It's very saddening, yeah, and very tough to counter effect these kind of trends. Probably like birth rates. It's a big issue that has been like plaguing a lot of countries. Also, think of Japan and think of other countries, and not always there is like a simple system of incentive to actually make things happen. So it's a tough problem for sure.
no. And that incentive you can put in place, it will have little results in the short term. So you can only make decisions that will have maybe impact in the medium term.
Wow. Crazy.
Well, no, let's stick to
Let's
our
still
goals.
stick to tech and see what's going on. You mentioned a very interesting article regarding SaaS unit economics, which I think it's worth mentioning. So the idea here is that the article essentially challenges the very much core of SaaS unit economics and how that needs to shift when it comes to new challenges in the market. So I thought that was particularly relevant. So the idea here, bottom line, just to jump to conclusion, is that the math breaks because it depends on high margin associated with the recurring revenue from existing customers. So to generate cash flow, you essentially need like a ton of new recurring customer and a very low churn rate. So the idea here is that, so two concepts to keep in mind. Of course, the CAC is the customer acquisition cost, and the idea here is that they focus on CAC payback period, which is getting actually longer, and that's problem number one. And related to that is actually the hidden cost of churn. So churn is not just losing subscriber and this is it. It actually has a massive impact, and it's not always top of people's mind, but it has a massive effect. What is your take on this one, Nick?
No, I like the article because it provides a lot of insight around the mechanisms around SaaS. So even though you can debate about the alarms around churn, around the specifics of the current state of the world, it's absolutely interesting to see how these metrics are computed, their effects, and how you can leverage on them in order to improve your position. And as you said, in particular at the early stage, SaaS businesses focus on growing. And maybe often growth seems to come solely from new logos that you put on board. But there are a lot of things that you need to be aware of very early on. Because, for example, churn, as the article says, is extremely important. And it boils down to the quality of product, the amount of competition, pricing decisions. There are a lot of levers that you need to pull in order to keep the numbers on track. And if you lose control of those, even early on, you're basically in big trouble.
Yeah, I mean, the idea here is that churn can quickly destroy the unit economics at a pace that is very, very dangerous, because it has like pretty much like two different costs. It's not just pure churn. So basically there is a direct cost and an indirect cost. The direct cost being, of course, the profits that are keeping sort of basically there is, of course, the bare loss of customer, and that's sort of the direct effect. And that's already huge, because essentially the idea is that once CAC is covered, then keeping the customer is where the high margins happens. So the relationship is that ideally you want a very, very short CAC, and then keeping as long as you can customers, so that the dynamic of marginality can actually be triggered. So, and they're not triggered necessarily in the first place before sort of the payback period for CAC, but they're triggered actually after that. So it's a double problem over there. On top of that, you have also the indirect cost, which essentially is the idea that expansion revenue is significantly cheaper than new logo revenue, meaning that expanding on new customer is definitely cheaper, because the big costs have been already taken into account when it comes to sales and marketing. So they're just cranking essentially like margin, while to actually add new customer, they call it in SaaS terms new logo. It's basically like new customers, and it's way more expensive and it takes like long. So actually it's a big missed opportunity if the churn rate actually shortened that period. So it's massive, the article really opens people's eye on this double problem, which is not as easy to solve as one can think.
And finally, it's a good source of benchmarks. So you can take a look at the averages, the okay, good and great companies out there, what they're doing. Even though even if they are later stage or public companies, that's still an interesting benchmark. So if you think that you will have a CAC payback of 6 months forever and ever, you are getting ready for a bad surprise probably. So
Yeah,
just
yeah.
benchmarks, take a look at them.
Do you agree on the CAC payback time mentioned in the article in what you're seeing in your experience, which basically say anything below 12 months is great, 12 months is still acceptable, anything above that is like can get more and more problematic. What is your take on this, given what you've seen so far?
Well, the point is when you are very early stage and you are maybe in that magic moment where you are in the product market fit area, product market fit area more or less means that your product is flying off the shelves. So you will enjoy kind of short-ish CAC payback, probably an okay churn, because I mean the product will not be complete. There will be customers that are you nail the problem, you nail the product at the initial as initial proposition, but then maybe something is missing and things get more complicated going forward. But anyhow, um, the early stage world is not exactly the same as the public world, so I can understand that a big public company that has a 12 months payback period is great, unlikely, rare, but great. I do agree that as a startup, if you're selling a product to enterprise customers, if your car payback is below 12 months, it's great because you have a huge flywheel momentum. You can quickly reinvest your revenues in new growth. So the numbers feel about right. If it takes more than 1 year, that's more complicated, of course, because again the flywheel is slower and you need more resources, your own resources, in order to support growth. So the shorter the better. Only the pros, the real pros, are in product market fit phase below 12 months.
Interesting. Is there a benchmark churn rate that you have in mind when you evaluate companies? Like, I'm not sure if there is like a range which is sort of the gold standard out there for B2B SaaS. No, I have no idea if there is anything. I mean, it probably depends on product. It depends on ticket size. It depends on a lot of factors, probably.
It
So I don't think there
depends a
might be.
lot. I think there is no unique benchmark. Of course, a lot of people tend to look at public companies, because I mean SaaS is more or less an understood model, and public companies have the whole story in front of you. So churn is actually a more nuanced metric. You churn in terms of logos, but within the logo churn, there are a forest of important things to consider. Revenue churn, for example. One of our portfolio companies for a while had a high churn, but very low, actually negative, high logo churn, but very low revenue, actually negative retention, revenue churn, because basically they were shifting the customer base willingly. So as an investor, if you just look at the logo churn, you say, I mean, they're losing a lot of customers. I mean, yes, and they wanted to lose a lot of small ticket customers in order to focus on higher ticket customers. And if you look at the cohorts, you would see that churn was actually just related to the old cohorts that were, not in target anymore. And new cohorts and the customers in target had negative revenue retention, meaning for each existing cohort, revenue coming from that cohort was actually going up and not down. so negative
Oh
churn.
wow, interesting.
So there is some
So it's
nuance,
more-
and
so
that's,
churn-
that makes it difficult to have some kind of complete benchmark. Net dollar retention was an important benchmark for a while. Like if you were above 130%, 120, something like that, you were great. Meaning, for each cohort, you were actually increasing revenue dollars coming from that cohort. But it was great in the zero interest rates phenomenon. Not
Fine.
anymore.
Good point.
So almost nobody has 100% revenue retention right now.
Interesting. Awesome. And with that,
things change.
Yeah, no, Nick, thank you so much. That's definitely interesting. So churn rate is really something to keep in mind. Is one KPI to actually double click and understand better when it comes actually to analyze company. So with that said, I think we are this is like the end of the episode. So that concludes this week's episode. We hope you found these updates insightful. Thank you everyone for joining, and thank you, Nick, for the big session.